Enbridge stock has gone up and down quite a lot year to date, and down the line this stock is up 3.5%. On the 9th of May, ENB stock presented their quarterly earnings, where they beat on both the EPS and the revenue, so clearly momentum is with them. Looking at the dividends, we also see why people seem to love this company, since dividend yield is at almost 6%. But that payout ratio is something to dive into. So without further ado, let's check the recent earnings. Looking at the financial results, we see that there are a few important numbers, starting with the adjusted EBITDA, reported at 5.8 billion, up from 4.95 billion, looking really good here. Cash flow is up as well, but more importantly, the cash flow per share and earnings per share are both up as well. Enbridge also reaffirmed its guidance with an expected EBITDA of 19.7 billion, up from 18 billion in 2024. Cash flow per share is expected to be around $5.7, up from $5.6 in 2024. And now something a lot of people like about this business. Enbridge has a diversified portfolio of 200 asset streams, and business and 98% is a take or pay contract, which look really good. On top of that, credit ratings are also looking pretty good, although I do prefer A credit ratings here. And on top of that, 80% of the EBITDA is inflation protected. And to me, all of this is very important, because one of the numbers most people tend to overlook is the net debt to EBITDA, reported at 4.9 times, which is increasing versus 2023, so that's something to keep our eye on. But down the line it is in a healthy range of 4.5 to 5.5. And remember that dividend payout ratio was reported at 123%? Well, based on the earnings per share, it's easily covered, since dividends were declared at $0.67, while EPS is coming in at $1.03. And distributable cash flow is sitting at $1.73, so also plenty of room there. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week, and also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Enbridge stock is a 97 billion market cap company. PE ratio is at 21.6, which indicates they could be fairly valued right now. And later in this video I will show you my 3 price targets for Enbridge stock, so make sure to watch until the end. Revenue is at 43.6 billion, and in this graph we see that revenue went up and down a lot in the long run. Most recently it is increasing again. And that's the thing with these kind of companies. They tend to fluctuate a whole lot more. But as long as the revenue goes up in the long run, we're good. The gross margin is increasing a lot over the years. However, most recently it is coming down quite a lot. And looking at the operating margin, we see that this number is decreasing as well. Most recently, something to keep your eye on. The net margin is increasing in the long run, and it looks like it has found its way up again most recently. And one of the most important numbers for Enbridge is the EBITDA margin. It is also increasing quite a lot in the long run, but again, in the recent quarters it is going down, so let's keep our eye on this number as well. The EPS is going up and down a lot as well, but for a company like Enbridge this is very common. Analysts have mixed feelings about the coming years for the EPS, but in general it is expected to see a decent growth, all the way up to $3. For the revenue, it is also looking pretty interesting. Analysts expect revenue to decrease quite a lot in 2025. From there, it is expected to see an insane growth in 2027, which to me feels like a fluke. Down the line, it's expected to hit 35 billion by 2028. Return on assets is sitting at 3%, which is a low number. Return on equity looks pretty good, and the most important number, return on invested capital, is sitting at 3.7%, which is a low number. It is similar versus the 5-year average, which is also very interesting. I prefer this number to increase over time. Current ratio is at 0.73, which is a decent number. Nothing really special to mention here, to be honest. And right now, Enbridge has 103 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Enbridge has 2.1 billion in total cash, so they can't pay down a decent amount of their debt. To me, this looks pretty bad. Potentially, this could be a red flag. So it is very important that free cash flow is growing, since this is used to pay down debt, of course, but also to buy back shares, pay dividends, and all other things. And here we see that free cash flow is going up in the long run, which is looking pretty good, but it is not really steady and consistent, so keep an eye on this number as well. Shares outstanding are increasing, which is something that I don't like. However, companies like Enbridge increase shares to raise capital and grow the business. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the P/E ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 6%, which is an insane number. Annual payout is at $2.65. Payout ratio is around 65% based on the latest earnings, and not the 130% displayed here. The 5-year growth rate is at 3%, which is a decent number. According to Seeking Alpha, they have increased their dividends for 1 year in a row now. In here, we see that Enbridge did increase the dividends at a decent pace historically. However, in the most recent years, it is not growing that fast anymore, which isn't a good sign most of the time. And in this graph, we see the expected dividends in 2025, 2026, and 2027. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase slowly from here. And overall, these dividends look really interesting to me, but how about the historical returns? I decided to compare Enbridge stock with the overall market, in this case the S&P 500. On the 5-year chart we see that Enbridge underperformed the S&P 500 with a decent margin. And keep in mind, this is including dividends. In total, ENB stock reported a 103% return, versus 123% for the S&P 500. On the 1-year chart it is getting really interesting, with ENB crushing the S&P 500 with twice the amount. On the 6-month chart it is a similar story, where ENB stock reported a decent 7% return. On the 1-month chart we see that the S&P 500 is winning again, with a whopping 9% return versus only 0.38% for ENB. So bottom line, in the past 5 years the S&P 500 was the better choice here. And most recently the S&P 500 is winning as well. So could this be the perfect time to buy Enbridge stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 2, 4 and 6%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 10, 11 and 12. For the free cash flow margin I'm putting in 8, 9 and 10. For the P/E ratio I'm putting in 17, 19 and 21. For the price to free cash flow I'm putting in the same numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. And right now Enbridge stock is around $44. I hit analyze and we see only red numbers. We have a low price target of $19 to $24. We have a mid price target of $27 to $33, and we have a high price target of $37 to $44. And to me, the mid price target is the most justified here, indicating that this stock is overvalued based on these numbers. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Enbridge is that it could be a great dividend income stock. However, it comes with a risk. This industry in general is a bit more risky to me. Most fundamentals look pretty decent, but I personally prefer a bit more steadier business or industry. Revenue that is being a roller coaster and also really high debt levels without any cash to support it is something that I tend to avoid. But again, from a dividend point of view, I do get the excitement. The only downside that I find with ENB Dividends is the lack of growth. It is slowing down a lot over the recent years, which is never a good sign. From a value point of view, it is also not looking that exciting. They are overvalued based on the mid-price target. So for now I'm skipping this stock, but I will keep analyzing them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.